Robschild. No investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Tuesday, April 29th, 2025. Today's episode begins with our headline: JOLTS, Jolted, snaps, and super micro shrinks. Job openings getting jolted might be overstating it a little bit, but we did drop today to 7.19 million openings, and in order for the economy to be good, we can't see this continue to drop lower and lower and lower. But as it stands, we're still not below the September reading of 7.1 million job openings. So for March, it counts as a higher low so far until we get a lower low. But then also looking at just the line of this chart, it sort of curves down and it's going more sideways than it had been going. So that could be a good sign. When we break it down, it wasn't just a few sectors. In fact, they said in their report, from the JOLTS report, that it was broad-based, with the largest decreases reported for transportation, warehouse, and utilities. Transportation is one of the really big leading indicators of a slowing economy. If people don't need to be transported as much, well, it means they aren't spending as much money, they're not, and maybe not working as much as well, which is why it's a good leading indicator. If we don't need as many jobs for transportation, it's a little bit of a sign. And then we actually had some increases in job openings, actually in finance and insurance and other services, and state and local education, wholesale trade, and manufacturing. But small amounts compared to the lower amounts in these other broad-based sectors. Snapchat, popular app. If you remember, this stock was being bought and sold for $83 a share back in 2021, and after hours we're currently sitting at a 14% loss. Mostly wanted to include that one to have it in the headline because I thought it sounded funny, but this one's a little more important. Super micro shrinks, down 16% in after hours. This is one of these companies that makes chips and stuff for AI. Since the dot-com bust, people have learned to follow the semis, and we will take a look at the whole index when we get to the charts. Second agenda item, green day. Stocks and bonds went up, but I'm still seeing some red flags that I want to talk about today when we get to the charts. Before we get there, let's do the community topics. What moves, if any, did you make today? Robschild sells his TLT calls for July 18th with a strike price of 95. Made some profit on that. I bought those calls when we got into this gap fill area on April 11th, and I said when I see TLT go strongly in my direction, I would want to sell it. This is strong enough for me, and there's never a problem with taking profits, especially in options contracts. Because if you don't win by the time it expires, it goes literally to zero. So that's what I did today. What moves did you make today? Comment below. Coming up, we still have continuous tariff updates. Supposedly there's some rumor coming out about a deal with India, and then Trump talked today trying to calm down the auto industry in the United States. So we will continue to see tariff updates. Wednesday, tomorrow, we have GDP coming out, which I am expecting to be negative. The Atlanta Fed is forecasting it to be negative, and off of this report, like I said on Friday's show and yesterday, the mainstream headline news will likely say something like recession starting, recession begins, ? We also have ADP employment coming out, which is a good precursor to the employment report on Friday. We have PCE data coming out. This is the data point that the Fed wants to see at 2%. At least that's what they say. We also have velocity of M2 money supply coming out, which I'll cover if it is interesting. It's been rolling over. I'll probably talk about it tomorrow. We also do have some major earnings coming out. I don't like to cover earnings all that often, but this week, supposedly, from what I hear, 20% of the S&P 500 by market cap weight is reporting their earnings this week. So hold on to your hats. It really could affect things more than I was expecting before this week. We have tomorrow on Wednesday, Microsoft, Meta, Facebook coming out. We have Robinhood, which I like to keep close track of because that's like more younger generation, like financial services kind of thing. I like to keep my eye on Robinhood. Thursday, we also have Amazon with their earnings coming out, Apple, and MicroStrategies. And then on Friday, to top it all off, we have the employment-unemployment report. We had the Somme rule be triggered at this point almost a year ago, currently sitting flat just over 4%. My crystal ball says that this is about to rise here. I think things will unwind very quickly when we get a higher high in this report. And this has a decent probability this Friday. As always, thank you for watching, subscribing, commenting, and supporting. Before we get to the charts, these are the daily reminders macro views. Click the link in the description to my website where I explain them. No changes in the crystal ball ratings, and as I stated earlier in the episode, one change to the Robschild portfolio. On my short term, I sold the TLT calls that I had. On to the charts. Starting with the S&P 500, the SPX, there's a trend line that I've been following, this white line that connects April 22nd of 2024 to August 6th, and we broke it. And we're sort of like retesting it at this point. We are currently above it. I don't see this as looking terribly bullish yet for a whole lot of reasons. One of them including this chart here where we have a lower low, a lower high, a lower low. And this can still turn out to be a lower high. I want to, we're going to need to get above really the 57.90 level in order for us to say that the pattern of lower lows and lower highs has been broken. Adding to the bullish case, the S&P 500 advanced decline line going higher. So this is a broad-based stock rally, not just a few mega caps getting even more extended. The VIX Fear Index, Fear Gauge, still dropping cautiously though. We're still above 20. The futures term structure of the VIX is still inverted. This is one of the red flags that I mentioned earlier. Another red flag, the CNN Fear and Greed Index, although stocks looking like they keep going up, we're still in fear mode. Follow the semis. Add to all of the other red flags of the semiconductor index not continuing higher and higher, in fact dropping today by 0.17%. I'm going to restate, when we broke this very long-term head and shoulders pattern here, and this was the retest candle, we never got a close above the wick of that candle. This is from a daily basis saying that the bears are actually still in control of this market on a daily basis. And with super micro earnings coming out so weak today, tells me there's a pretty good chance of the semiconductor index rolling straight down from where we stand, but that's just a crystal ball reading. Red flags everywhere, including oil, to add to the red flagness of what's going on, while we're looking like we might be developing some kind of bull flag. Recently, trying to maybe get above $65 a barrel in crude. The last 2 days have been just falling off a cliff here. Crude oil dropping is not a sign of healthy, good economic activity. Quite the opposite. Respected traders such as Gareth Soloway, as late as this morning, was still sort of on some hopium, I'll call it, that we would get back into this wedge. We are clearly not going up in the Treasury note, 10-year Treasury note yield. So now we can, in my book, get rid of this bull flag. No longer a bull flag. This is simply dropping. I am short gold. This is the chart of gold. I'm actually short with GDXD, as you saw in the beginning of the video. Partly because I think gold is simply overvalued by a lot right now, but I'm able to comfortably go short here because of the chart pattern that's aligning with that idea, this being a very, very clear bear flag. And it's maturing to the point where it's pretty much ready at this point to break it down to the downside. I will be exiting this gold short position when we get below 3,200 in gold. I've been using HYG as a junk bond bellwether, and I've been saying how we've been back into this range where credit spreads were just unbelievably tight, which this fund is basically in that range now. And so that was giving me the sense that the stock market might have had more legs, but instead all I'm seeing is another red flag, because when we look at all the junk bonds using the Fred chart of Bank of America's U.S. high yield index option adjusted spread, we can see that we are still very clearly in a higher high, higher low situation. In order for me to believe that this red flag is off the table and that we can indeed go higher in stocks, which can happen eventually, but we're not there right now. We're just simply not there. And I'm not expecting that we can get there until we take out the previous higher low, Liberation Day of April 2nd. If junk bond credit spreads get below 3.42, only then can I be convinced that Mr. Market may drive the stock market higher from here. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.